Yeah, so everyone, this is Tom Eibold from EY. He is here to talk about what is emerging as both a natural and killer use case for blockchain technology, decentralized finance, also known as DeFi. So I think we're going to discuss the resemblance DeFi has to the early days of internet protocols and why that's important, as well as introducing technologies that your organization can potentially leverage in the future. So Tom, if you want to take it away.
All right, yeah, thank you. Great to be here. My name's Tom Eibold. A little bit about me. I'm a product owner in our blockchain group, currently working on our rights and royalties management solution with Microsoft that's using blockchain technology. I also have a handful of projects and research initiatives I've done in the decentralized finance space, also known as DeFi, for those of you who don't know much about it, which is really this new composable financial system built entirely of code on the Ethereum blockchain. And it's what we're going to be focusing on. So let's go into the objective of today. Over the next 20 minutes, I'll introduce new concepts and technology that are shaping the future of finance, and to get you thinking about how your organization can leverage them So the agenda real quick is to provide a brief history of internet protocols and the impact they had on its development and maturity. Then we're going to look to see whether these protocols can impact finance the same way that they impacted the internet and data exchange, and bring it home to why DeFi is important. So I'll dive right into it. A brief history of internet protocols. To level set, when we say protocols, we're referring to a system of rules that determines how an activity is conducted. They're necessary for any network where you have independent things interacting with each other. One of the best examples that we all abide by are driving protocols. So regardless of which direction we're going, we drive on the right side of the road, and we stop at red lights, and we go on green lights. And we need driving protocols because the alternative is to negotiate these rules in real time with other drivers, which would be complete chaos. So these driving protocols help us get from A to B efficiently. And really the same is true when you're trying to send digital information. So the internet is this collection of protocols all working together with one another to deliver information to your computer. The two foundational layers of the stack are known as TCP/IP, which define how computers can send packets of data to each other and which applications are allowed to do it. And there are more protocols that were built on top of TCP/IP, like SMTP, HTTP, and FTP, and so on. So what's interesting about these is when you have standards like SMTP, which was basically define the rules for electronic mail transmission, you can have consumer-facing clients that were built on top of it that use the standard. So this ensures having the SMTP protocol allows my Gmail account to send emails to a Yahoo account, etc. Another protocol we'll briefly look at is HTTP, also known as maybe the World Wide Web. It's the set of rules for transferring files like text, images, etc. between servers and your computer. And on top of HTTP, it enabled, browsers like Internet Explorer, Safari, Firefox, Chrome, etc. So when you combine all of these rules of the road, you get an infrastructure that's capable of supporting, 40,000 Google searches every second and 3 million emails every second. So now, can internet-like protocols be applied to finance is the question. So given there's maybe 15 minutes left in this presentation, the answer is obviously yes. But for a long time, the answer was no. So two things were preventing this. One, there was no way to preserve digital scarcity in a digital context. And two, there was no vehicle for deploying and enforcing these rules of the road. So the internet stack is comprehensive, but one gap existed. the internet protocols were hyper efficient at distributing data across the globe just by, replicating copies and sending those copies of data. And this was efficient because this was all, this data is consumptive value. It's things that can be consumed. You're reading it, you're watching it, you're listening. And replication doesn't destroy this consumptive value proposition. But the same mechanisms aren't appropriate when you're trying to send monetary value, because replication destroys this value proposition. So put differently, the internet lacked this mechanism to preserve data scarcity, and it couldn't support the creation and maintenance and transmission of data with monetary value, i.e., digital assets. So, well, in 2009, the first barrier was overcome with this concept of the blockchain, which proposed, to maintain digital scarcity. So we now had that capability. And in 2015, the second barrier was overcome with Ethereum proposing smart contracts. So we have this vehicle for embedding rules or business logic on the blockchain. So with those two ingredients, the first general finance protocol was born in the form of an asset standard called ERC-20. So ERC-20, which is the standard for, it's an application level standard for Ethereum. It was proposed to represent any fungible asset on the Ethereum blockchain. And 3 years following its release, the number of different fungible digital assets increased from 572 to 200,000. More than 95% of tokens across blockchains are ERC-20. So a largely overlooked element of the ICO boom in 2017 was that ERC-20 standards made it incredibly easy to create a new digital asset as a result of being built on open source standards. So when things are open sourced, the barrier to entry drops dramatically. So now that we have this technology that allows us to create scarce digital things in blockchains, scarce digital things in blockchains, and this vehicle for deploying and enforcing rules of those scarce things in smart contracts, and a standard way to represent those things, we can put it all together and have the ingredients for a decentralized financial system. And this is exactly what's happening on top of Ethereum. So what is DeFi? DeFi is simply a bare bones financial system living on a blockchain that relies entirely of smart contracts to facilitate and enforce financial transactions involving digital assets. So transactions can be as simple as swapping one asset for another, or complicated like taking out a loan collateralized by another digital asset. So there are asset exchanges, lending platforms, loan refinancing, high interest savings accounts, derivatives, prediction markets, and structured finance products, all largely built within the last 24 months on Ethereum. So the value of DeFi is its contribution of these new financial primitives. So primitives are essential to build more complex systems and exist in a variety of disciplines like math, science, computing. But in computer programming, a primitive is a basic interface or segment of code that can be used to build sophisticated program elements. So moreover, these new financial primitives are highly composable and can be stacked to create higher order applications. And this aspect of composability allows developers to quickly and easily take different financial primitives and use them in different combinations to create new applications or business models. So the cost and effort associated to creating new financial products and services is dropped dramatically. So basically, moral of the story, anyone can create complex, advanced financial applications now. So while it's still in their early stages, these primitives are tackling core finance functions such as asset exchange, lending, derivatives, and asset management. And these are, just a few of them. There might be a few more that I left out, but these are building blocks towards the next generation of financial applications and a movement towards this financial system that's globally accessible and free to use. So again, it's all happening on top of Ethereum. For the most part, most of it is happening on top of Ethereum. So it's cool to see for sure. So I'll dive into the next piece, and you might start to see some similarities to how to the internet stack, which we saw before. So I'm going to go through just a few of these. So asset exchange, it's if anyone in the Zoom call has ever traded stock on E-Trade or Charles Schwab, or bought cryptocurrency on Coinbase, you've relied on those institutions. They're trusted third parties to hold your assets and facilitate the exchange. Regardless of which intermediary you go through, the process looks pretty familiar or similar. You have a buyer and a seller on both sides and a broker in the middle of both, and they facilitate the trade or the exchange of those assets. But now we have asset standards and a vehicle for enforcing these rules of the road. And we can program this exchange using smart contracts. One of the protocols that is doing this is known as 0x. So the 0x protocol establishes these set of rules for exchanging assets on the Ethereum blockchain. So just to explain how it works high level, let's just take an example of a trade. Let's say Ashton has token A and wants to exchange it for token B. I have token B and want to exchange it for token A. Using the 0x standard order contract, Ashton could create an order specifying a price and post it on the blockchain. I could see Ashton's order, agree to it, send my token B to the order contract. When the conditions of the order are met, the contract executes and an atomic swap occurs, meaning that token A is sent to me and token B is sent to Ashton at the same time. So this transaction is settled on the blockchain. Ashton's wallet reflects token A, and on my wallet reflects token B. And this process was completely facilitated by smart contracts instead of that trusted intermediary. So on top of the 0x protocol, we're already seeing decentralized exchanges using the protocol to operate liquidity pools for Ethereum-based assets. So a few of them are Radar Relay or Paradex, and there's more, but starting to see some similarities to how the internet was started. The next thing we'll dive into is lending real quick. So lending centers around, is the kind of the foundation of modern banking. And you could say it's the original pillar of finance, some might say. So smart contracts are now being used to standardize the lending of digital assets. So we'll look at another example here. So this is going to be a typical collateralized loan. So in many situations, we have reputation that takes place of collateral in the form of a credit score or income verification. But for simplicity's sake, we're going to assume some amount of collateral is posted. And for all of the crypto lending desks out there, this is how they operate. So the borrower provides collateral to a lender, and in exchange is able to borrow an amount of money. At a later date, the borrower pays back the debt with interest. The loan is closed and the collateral is returned to the borrower. It's a straightforward collateralized loan. So now, as you probably guessed, this process can be standardized for digital assets using smart contracts. So one of the protocols doing just this is MakerDAO. MakerDAO developed a smart contract-based collateralized lending protocol, and here's how it works. Essentially, if, say, Ashton has 100 ETH in his wallet and wants to borrow against that amount, he sends the 100 ETH to a smart contract to lock it up as collateral. This contract's called a collateralized debt position, or a CDP. And by locking it up in the smart contract, Ashton now has the ability to borrow an amount of a stable token, which is just it can be a US dollar backed, but it's usually an ERC20 token that represents $1 US. So when he wants to close his debt position, he sends the same amount borrowed back to the CDP, and his original 100 ETH collateral would be unlocked, minus any interest that was accrued. And just one little caveat, due to crypto's volatility, the minimum collateral ratio is 150%. So all of these loans currently have to be over collateralized. So MakerDAO, and also a very similar protocol called Compound, is enabling developers to integrate lending and borrowing services in their applications. A few of them just off the bat are InstaDApp and Outlet. Outlet Finance is a high interest savings account. So cool things, you should check it out, built on Compound and MakerDAO protocols. Asset management, just pretty simply the process of managing investments on behalf of others. So SET protocol is a non-custodial protocol built on Ethereum that allows for the creation, management, and trading of sets. So sets are ERC20 tokens that represent a portfolio or a basket of underlying assets. Each set operates and periodically rebalances its portfolio according to a strategy coded into its smart contract. So here's a fun example of one set. This is called the ETH RSI 6040 crossover yield. It's kind of a mouthful. That attempts to capitalize on trends by detecting the speed and change of price movements for ETH. So it automatically triggers rebalances if the relative strength index, or they call this the RSI, crosses below support at 40 or above resistance at 60 to indicate your price movement. So if it falls below 40, the set will rebalance from ETH into Compound USDC, which is just a stable token to the US dollar, and automatically start to accrue interest on your cash when that market is bearish, because they take that USDC and lend it out. So the solid green line is the ETH RSI 6040 set, while the dotted line is the price of ETH. So as you can see, when the price of ETH dropped around the 1st of March, the set automatically switched from ETH back into USD. Once the price of ETH started to go back up, it switched from USD back to ETH. So pretty cool stuff, and it looks like it's pretty profitable as well. So the SET protocol is enabling this ecosystem to represent a portfolio of baskets of underlying assets. Being built on top of it is token sets, and I'm sure there's more, but let's dive into the next piece, derivatives. So derivatives, just for the sake of time, and I want to get to questions, I won't go as deep into derivatives, but a derivative is a contract between two or more parties whose value is based on an agreement, on an agreed upon underlying financial asset. So the gross market value of OTC derivatives is 12.7 trillion. So this is a really large area. There's many different types of derivatives, but one example that we'll kind of walk through is a derivative for a short position. So a short position is basically where someone borrows a share from someone, sells it at a going market price, and waits for it to fall so that they can buy it back at a lower market price, and would then return the borrowed share to the lender and keep any profit that they made. So usually I'd go into the technical details behind how this is done, and for the sake of time, I'd like to just state that similar to before, smart contracts are being used, and one of the protocols that is doing this is known as DYDX. So you can check it out if you're in your spare time. Super cool stuff, and this space is just innovating like wild. Every day there's some new financial product built on Ethereum. So why DeFi is important? So we just walked through what I call the 4 pillars of the decentralized financial system, asset exchange, lending, asset management, and derivatives. And now we'll bring it all together kind of on how we got here. So we started with blockchains, this technology that can preserve that digital scarcity of a digital thing. Then we needed the vehicle for that scarcity, and we had it with tokens. And then when you layer in smart contracts, which is this way to program the behavior of those scarce items, and when you add all of those up, you get a digitally native applications. So now they say history doesn't repeat itself, but it rhymes. So let's take a look and see how it compares. So the bottom gray layers are foundational protocols that are application agnostic. But as you go higher up the stack, these rules of the road for specific use cases leverage everything below it and start to kind of take shape. So with the internet, it was this electronic messaging, web browsing, and file sharing. And with DeFi, it's asset exchange, lending, asset management, and derivatives, just so far. The interesting thing, which I don't have the answer for, is what industries will develop on top of the stack. The internet brought, kind of gave birth to e-commerce, digital media, and social media, each worth hundreds of billions of dollars a year. So it'll be exciting to see what these new financial protocols give birth to. So we're kind of seeing this continuation of the evolution of the internet, and that being this new module being bolted onto an already global infrastructure that provides the ingredient for a financial system native to the web. Over the next decade, we anticipate DeFi to bring a Cambrian explosion of financial innovation that will be built on top of public, not private, blockchain-based infrastructure. So this innovation will come from startups, fintechs, and other financial institutions, and will have a pretty significant impact on the way financial products and services are developed, accessed, and used in the future. So with that, that's the presentation. And definitely, yeah, this was great to be here and open to any questions anyone has.
Awesome. Thank you so much. I think that was very informative for certainly a lot of us. So hopefully our attendees enjoyed that. So let's start with a Q&A question actually that we got within the Zoom chat, and we'll kind of go into Huva as well. So say I have a CDP, what happens if there is a bug in the contract? Would I lose all my money? And wouldn't it be safer to rely upon blockchain with stronger governance policies?
I don't think stronger governance policies would solve the issue of a bug in a smart contract and your money locked up in a lending protocol that was affected by it. What's on Ethereum, which to mitigate the risk of some of those, is decentralized financial insurance. It's called Nexus Mutual is one example. I think there's some others, but basically you can take out an insurance policy on if there was a bug in these financial protocols, which are highly risky right now. I was watching another podcast which says you could probably factor in about a 40% maybe risk of using financial protocols. But as each day goes on and they aren't hacked, or they do get hacked and then that gets fixed, it really validates that these things are going to be foolproof, which is kind of one of the best benefits of public blockchains, is that they've been really kind of true tested and resilient in that standpoint. So over time, it's only going to get stronger. But yeah, as it is new, these things are risky, and there's that risk that there's a bug and you could lose your money. But yeah, good question.
Yeah, totally. So we had a question about which is best to go with in DeFi. Is it ERC 20 or ERC 721? If you can kind of just give a little bit of background of why each different use case is necessary, maybe fungible versus non-fungible, explain that a little bit further as well.
Yeah. So it's not which one's better. There are two completely different things. ERC 20 is for fungible tokens. So if I have, Ether is fungible. So I can give you an Ether and you can give me an Ether, and they're the same Ether. But there are non-fungible assets, which are ERC 721. So they're unique. So my one token is unique, and if you gave me another token that was the same, it would be different. So an example of this would be Decentraland is actually this virtual real estate built on Ethereum that, their goal is to be kind of the oasis or the VR world where people can buy digital land in this world. And that's represented as a ERC 721. So that land is a certain position on the map, with whatever on it, if someone builds something or who knows what it is. So if you had one parcel of land in Decentraland and I had one parcel of land, we couldn't just swap it because they're not equal trades. Mine's unique and mine's the only one that's this position with this stuff on it, and yours is different as well. So it's really, a lot of blockchain-based gaming uses these, ERC 721s, which are kind of, collectible items. You can call them that way. But yeah, not sure. Did I answer the question?
Yeah, I think you kind of just went through, what are the differences between each, definitely, which was helpful for our audience. So another question we have are financial exchanges have been programmed and automated for a long time. What would you say is the key value proposition of smart contracts above and beyond this?
Key value propositions of smart contracts beyond this? Related to what? Sorry.
Financial exchanges and how
the future of exchanges.
For a while.
Yeah, I mean, Uniswap is a really great example of kind of one of the most innovative exchanges out there. Basically, with decentralized exchanges, I think it really unlocks a lot of liquidity. It's going to unlock global liquidity pools, so anyone can access those liquidity pools. Anyone can easily start lending out money, different assets. One example that comes off of top of mind is this project called Realty. Basically, it's real estate, like a piece of land in I think it's Detroit. It's an apartment complex. You can buy a token of that apartment complex and receive interest based on the rent payments every month. But what's even more interesting is you can go and trade those tokens on Uniswap. So it's just a very explosive kind of a growth in decentralized exchanges that anyone can go on to Uniswap, create a token, create a liquidity pool for that token, and start having a marketplace and facilitation of that exchange. Sorry, did that answer the question?
Yeah, I think it was an example of that, especially in a decentralized exchange atmosphere. So I think we've had a lot of conversation already about central bank digital currencies. We're going to continue to talk about it throughout the day. Obviously, it's a hot topic with the current crisis we're facing and some of the regulations that are being put in around it. So, so do you think central banks are going to issue CBDC? And then, obviously, if yes, how will this impact the cryptocurrency market?
Yeah, great question. I'm super excited to see how that plays out. I believe that there will have to be a digital dollar at some point, whether it's a CBDC or it's a more, decentralized, something like DAI or USDC. It'll have to happen just for us to stay competitive and have access to these global financial markets in the future. China is certainly on the forefront of this. So if we don't, we will definitely be at a disadvantage. But once we do have the capability for, a digital currency, I mean, the real benefit is going to come when you start using it on public blockchains like Ethereum and can have access to these open financial markets and new financial primitives. And then it's only going to expedite the amount of new financial products that, consumers can have access to. I think in the future, every product will have some form of fintech embedded into it, and it will likely, in my opinion, be linked to things on the Ethereum blockchain that are providing those services.
Definitely, yeah, that's a great point you made there. And specifically around that, do you think that we might still be interoperating with centralized and decentralized systems in terms of finance in the future, and maybe we have still two big centralized and decentralized kind of platforms within the future, or I guess.
No, yeah, for sure. Aggregate, yeah, having centralized parties are, critical. Coinbase isn't going away, anytime soon. They're actually pretty helpful. They provide a lot of, benefits and, ease of use in using these applications. So there will be more of them for sure, and it'll be good. It'll help drive adoption and ease of use and growth. So yeah.
Yeah, definitely. Jack, did you have any other questions? I think there was one on the SET protocol. Did you get that answered at all?
Yeah, I listed that one actually. That was SET protocol kind of stacks up to index funds pretty closely. Do you think, or I guess, how do they compare and contrast?
I don't really have a huge viewpoint on that one. From like a tax standpoint, which I was looking into, they behave very similarly. Well, similar to like an ETF as well. So when it is rebalanced, there's some gray area in terms of, do you pay taxes on that or not? But I've heard, just, this isn't tax advice, but when you buy the set, then that's a taxable event. And when you sell the set, it's a taxable event. But whether, each time it rebalances is that one, something a little up in the air on. Yeah, sorry, I don't have a huge viewpoint on that one though.
Sure, definitely still insightful. Yeah, I think that it's about anything I can think of.
We just got another Q&A actually from
awesome.
So you speak a lot about Ethereum. What's the difference between Ethereum and Ethereum Classic? Does DeFi work on both blockchains?
Yeah, so good question. Ethereum Classic was a fork of Ethereum. Basically, there were two sides of the argument saying I think it was to increase a block size, and the Ethereum chain decided to not increase the block size or something along those lines. And also, it could have been, I wonder if this was around the same time that there was a hack. So they were thinking about reversing funds. So basically what happened is Ethereum forked and I think reversed the funds and maybe also made some other improvements to the protocol. Ethereum Classic did not, and kind of maintained that really, like, we are a blockchain, we are immutable, whatever happens, is going to be permanent. DeFi, to my knowledge, is not, I haven't ever heard of one thing being built on Ethereum Classic in regards to DeFi. But yeah, really the developer pool, the ecosystem and growth and DeFi space is all happening on Ethereum. Yeah.
Yeah. Awesome. I think that's all the questions that we have.
Cool.
Thank you, Tom.